And thank you to KSI and ECKL for organizing this. Welcome back, everyone, to the most challenging period of the day. Whether it's graveyard session or not, it depends on the lunch you just had. I hope none of your competitors stole your lunch, or you ask the question of who stole my lunch, because that might not be the right focus. If banks want to translate this opportunity in ESG and sustainability into a new stewardship leadership role, then don't compete, don't steal lunch, share the meal, share your lunch. Collaboration in your sustainability agenda will smooth the speed of transition. And at the same time, happy Mid-Autumn Festival. The topic for the next 90 minutes panel is Sustainable Banking and Finance, Promoting Sustainability and ESG. So this morning, we heard two pillars. Both technology and sustainability is mentioned as a necessity for banking of the future. So whilst we acknowledge that banking can be done everywhere but never at a bank, its impact on society and community is crucial and critical. In fact, the CEO of HSBC this morning presented a critical view on the role of banks in ESG and sustainability transition and trajectories that could have covered the whole of this session. As preamble to our panel topic of sustainable banking and finance, I will start with three questions. Number one, do you know that according to Elon Musk, Tesla will no longer accept Bitcoin over climate concerns? Bitcoin uses incredible power consumption and has become a matter of great concern. Arguably, it uses more energy than the entire countries such as Sweden and Malaysia combined. So can the mining of Bitcoin be greened? Secondly, do you know that although the world is talking about globalization, the spotlight is on Malaysia? Why? Arguably, Malaysia's ESG and sustainability policies and practices need to be broad enough to cover the S in the ESG, which encompasses human rights, labor rights, and the global supply chain that comes along with it. Thirdly, do you agree that the future of all humanity now depends on bankers and venture capitalists? To help you decide or provoke your arguments whether banks can provide soft sanctions to its customers and therefore speed up the sustainability transition and trajectory, listen to this short video. Can I have the video? This video focuses on ESG.
A complete fraud.
Investing.
Fraud. It's so ridiculous. Governance has been addressed. That's useful. But, you know, this idea that you're going to get a stamp that says, oh, listen, like, you know, my supplier, you know, I've offset their carbon credits and now I understand my, it's a joke. It's jargon. And I think what people are doing right now is using it as a way to, you know, for example, like if you can paint yourself as ESG, in Europe, you can essentially borrow money from the ECB at negative rates.
I'm gonna come over and give you a massage now.
It's a carry trade.
He doesn't want you touching him. Coronavirus.
Go Chamath. Go Chamath.
Hold on, but I personally believe in climate change. I think we need to do something. And so the problem with ESG is it's going to take years for this.
But when you hear JP Morgan yesterday say they're not going to finance fossil fuels, or you hear Ed Bastian at Delta say he's going to spend $100 million of real money, by the way, effectively buying carbon offsets and investing in new biofuels every year, you say...
Two things. JP Morgan, by saying what they said, will be able to borrow billions of dollars from the ECB at negative rates.
You think that's what that is?
It's obviously what it is. It doesn't have to work. They don't need to do anything. They are now getting free money from Europe for basically being able to say this.
And you don't think they would get that money otherwise?
No, because Europe basically has this condition where you can issue green bonds and you can have all of this, you know, checks and balances at the, so that's one thing.
Okay.
It's going to be very important for you to really be able to diligence the supply chain all the way down to the supplier and the supplier's supplier.
So when you Microsoft
that's
to
a
say
very
they're
hard
going to
thing.
do, for example.
These are useful statements. It's great marketing, but again, it's a lot of sizzle, no steak. I think that what we need to do is invest in actual companies that can go and count,
right,
and can go and you know, legitimize the actual impact that companies have, so that you can do the right amount of carbon offsets. And then you have to have a legitimate exchange where you can actually trade them. So if you really believe in climate change, you got to do some hard work now.
Okay, by the way, Virgin Galactic is going to be throwing off a lot of carbon. Do you buy offsets?
Galactica.
Galactic.
Yeah, we have a plan to sort of get to sustainability.
You do? Why? If it's all...
it's important.
He believes
really
it.
important.
He just said he believes it.
Thank you very much. So that young man is a billionaire. He's a venture capitalist, and his name is Palihapitiya. And just from that video to all the venture capitalists and bankers here, the fate of the whole world is in your hands. So ladies and gentlemen, allow me to introduce the 4 panelists. We have got no bankers, but a good combination of 3 former bankers and a rating agency and a strategist from Deloitte. So these are leaders who must adopt or risk their institutions into irrelevance, because these leaders are setting the direction for changes, and these leaders have done some preparedness for the roles of bank. I'm inviting the first panelist, Mr. Peng. He's the Chief Executive Officer of Deloitte Malaysia. As I Googled him, I saw that he wrote the latest on scenario planning on navigating through the prolonged pandemic. So for the next 10 minutes, Mr. Peng, he will share with us on how sustainable banks can navigate risk and find opportunities through strategy climate risk management. Over to you, Mr. Ye.
Thank you, Datuk Noripah. Organizer, can you flash up my slides? In the meantime, maybe I will just provide a few background narratives. Yeah, I think what we heard just now during the interview, to a large extent, deal with the real fact in life. For example, like collecting ocean waste and recycling that. So how many businesses, how many people are doing that, right? Those are activities that can make a real impact, right, to the planet, but it's very costly to do that. And hence, we have to find a way, right, to champion and sponsor the undertaking of such activities that can make a real impact to our planet. I think until now, the government and the taxpayers, right, borne most of the costs, right, to transition from the very conventional economy to the greener economy, right? And the future of financial services, right, is very important as financial institutions being one of the major stakeholders in the ecosystem with very strong balance sheet and comprehensive business operation outreach, right, to the borrowers, to the lenders, to the regulators, to the customers, to the client, and also the talent, would be able to make a huge impact, right, to the world in terms of transitioning, right, from the existing economy to the greener economy. And I think the time has never been as critical as what we are currently facing in terms of dealing and confronting with the issues, right? So we are no longer talking about climate change. We are no longer talking about climate risk. Rather, right, we should look at it seriously, because we are now in climate crisis, I would say, right? So those are some of the very important preambles that I would like to cite. And in that context, I've prepared a few slides which talk about sustainability in financial institutions, and specifically, how can we navigate risk and how can we find opportunities through strategic climate risk management, because climate risk, right, is a big thing, is a crisis, and if you are not able to manage that, then you have a big impact as regards the sustainability, right, in the way that we live, in the planet that we live, and in the life that we are currently enjoying at the moment. Next slide. When we talk about strategic climate risk management, generally there are a lot of information that corporates have got in the drawer as regards corporate governance framework. I think a lot of those stuff are relevant and can be used. But in addition, I think as far as the climate risk is concerned, yes, got some unique challenges that set climate risk apart from the other business risks and government governance risk that an organizations is overseeing and managing. The first is on data, because there are really not enough relevant data in granular detail, right? And forward-looking data that is important for us to manage the risk. There are also divergent in methodology use across jurisdiction, vendors, and regulators. So this is a very unique challenge, right, in climate risk management. The second is on the expertise, right? The lack of expertise, understanding, and on all the sustainability across the financial institutions personnel, from the top all the way to the lower level of the hierarchy. The skill required, knowledge, experience are all very new and very complex. No one can claim that they are the guru in this space and they are able to come out with a comprehensive solutions that address the issues. And number three is the future risk predictions. Very frequently, including financial advisors, accountant like me, we always use the past data, right, to extrapolate and to project what will happen in the future. But in the case of assessing climate risk, I think the historical loss experience data has got less relevance and bearing in estimating the future risk. Time horizon is also an issue, because for financial institution, especially the bank, usually will plan and look ahead for a 3 to 5 years horizon, but climate risk matters are of a much longer time horizon than that. The fifth one is on the due diligence. There's a need for us to look at all the material counterparties across the entire value chain, right? Looking at how resilient they are. There are many companies in Malaysia, though may not be directly facing climate risk issues, but because they export their products to overseas, including to the USA, right? Where now ESG is a big concern, and therefore, right, there's scrutiny looking into the way that they undertake their business, their operations, whether they are in line, right, with the ESG agenda. And therefore, there's a need, right, to look across the entire value chain, which are sitting, right, in different parts of the world, and that make it even more challenging to deal with. Last but not least is the proportionality, where there are some governance structure. There are some rules set by the authority as regards ESG compliance and the governance framework to be looked into. But what is the relativity, right? At what degree and what size of the companies or businesses that need to be in full compliance, and are there companies that of smaller scale be exempted to be in full compliance with all the rules and regulations? So what is the level of detail, and what is the disclosure requirement, so on and so forth. So that make it very challenging, right, to apply a set of rules across the board, all kind of businesses along the value chain, right, and business that are of bigger size, medium size, and smaller size. Each and every one of them contributes to ensure that the whole region and the entire world, right, work towards that directions. But how can we ensure that each one play a part, at what degree and to what extent? So those are some unique challenges, right, that set climate risk apart from the other business risks. Can we turn on to the next page? And looking at those challenges, right, we've got to find a solution, right? We cannot just acknowledge that, no, these are the problems that we face, but we have to seek, right, to come up with a solution to address that. And here I'm offering 5 key themes that would address the robust challenges and to provide an effective oversight to the financial institutions' approach towards the identification and management of climate risk. Number 1 is on the strategy and business model. Number 2, governance and culture. Number 3, risk management. Number 4 is on the scenario analysis. Last but not least, on liability risk. Let's turn to the very first pillar. If you can turn to the next slide. Now on strategy and business model, right? There's a need to incorporate a clear path towards meeting global targets. Example, net zero emission, ensuring that the words are converted into real actions, right? You got to walk the talk. And there are some considerations for business leaders here. Number 1 is to ensure that the resilience of business model to sustainability is considered, not just in the short term, but mid and long term as well. There must be tools that are used to ensure that the strategy take into account the external business environment, and there should be opportunities for products and services, right? That to be designed and rolled out to help the whole world to transition to greener economy. And the engagement policy to need to address the communication with all the stakeholders in the entire ecosystem, right, including the taxpayers, the regulators, and the business partners. I got some statistics here that as far as the business opportunities is concerned, right, based on some statistics, in 2020, the ESG fund that's available in United States has reached $51 billion, which represented a 10-fold increase from 2018, and is estimated that the demand for ESG fund, right, for the entire world would surge to USD 53 trillion by 2035. And therefore, there are a lot of opportunities here, right, for the financial institutions, banking sector included, to really look at the existing service offering, right, especially those conventional ones, and see whether there's a need, right, to modify that to meet the future demand, right, of the clients, of the borrowers, and so on and so forth.
Mr. Yi, allow me to interject. You have another 5 minutes in your presentation, so if you could probably work within that 5 minutes.
Yeah, thank you. The next slide. I just have a few more slides to go. And the second areas to look at in coming up with a solution is to look into the governance and culture aspect of the organization. The tone must be set from the top to establish strategy, risk culture, and risk appetite, and the internal control framework to ensure sustainability. Some of the consideration for business leaders to ponder is that the leaders is the one that drives the agenda, and the leaders should challenge the senior management on the gaps that's identified and try to find solutions to fix the gaps. And there must be training and experience gap on sustainability that need to be identified, right? Because it's something very new, and therefore we got to acknowledge that we don't know what we don't know. And once the gap is identified, then we seek to fix it. Then on the corporate structure, it has to be very effective in cascading down the messages all the way, right, to the lowest level. And the institutions must come up with KPI to ensure that the people behavior, right, are influenced accordingly, right? So that over a long period of time, we will be able to inculcate a good culture to be ESG compliant. For Deloitte, for example, more than 5 months ago, we launched globally our global climate blueprint, where we set for ourselves some of the very important agendas to pursue, including cutting down the carbon emissions on travel by 50%, and to go for 100% building occupancy that are powered by renewable energy, so on and so forth. And we are also taking steps to change the spending behavior, consumption behavior of our people, be they stay at home or at work. Say, for example, encourage our people to use container rather than using a disposable plastic bag, right? And even if they want to use a bag to contain and carry something, use paper bag, for example. So those are the things that we all can play a part, right, to create a culture that will go to contribute towards a green and economy. Next slide. And on risk management, I think we got to set appetite, the risk appetite that we are prepared to undertake, right? So some of the considerations is that the risk identification process should cover a full range of the sustainability risk, and there should be some risk metric that we map up, right, and be looked into, and the leaders must understand, right, the scale of uncertainties and the sustainability risk appetite, therefore would be set accordingly. I know a lot of financial institutions are very keen, right, to embark on the green agenda, for example, stop funding coal mining, right, and increase the funding on renewable energies like wind power, and maybe going forward, how to harvest hydrogen and convert that into power. But if we go on those new technology, it probably mean that the gestation period, right, would be longer, and there are more risk to undertake as compared to funding conventional investment of projects. And in this way, the management of the financial institution would need to come to terms what kind of a risk level or appetite that the organization is prepared to undertake. Next slide. This is on scenario planning. So that's very important for us to come up with different scenarios, because it's simply too many variables here, right? Because you are looking at deteriorating environment, to what extent and how rapid the environment will deteriorate, and things that we are going to do, to what extent you will reverse, right, the situations, how impactful are the measures that we have, and so on and so forth. Right, and when we make investment into greener energy, right, developing technology, how sure are we that you'll be very successful, and you'll be able to be to yield a viable return on businesses over time? So there's so many variables there, and there's a need, therefore, to set different type of scenario and then analyze that, so that we know what is the worst case scenario, best case scenario, and most likely case scenario for us to plan forward. And last but not least, let's turn to the next slide on the liability risk. This is where we look at marketing disclosure, we look at product offering, look at the conduct risk, and so on. I think many financial institutions may be keen to roll out new products, but there's also a concern whether the people that are marketing those products would be solely looking at maximizing the profit, or is actually have the positive impact of ensuring that the ESG agenda is met or pursued. There are also worries about greenwashing, where companies will be window dressing, but very little substance in terms of making a positive impact. So those are the liability risks that need to be considered when the governance framework is designed, developed, and implemented. These are the few risk areas that need to be considered, and I hope careful study performed, right, to ensure that the eventual governance framework developed would be comprehensive enough to address the risk arising from climate risk. Let me just conclude with the final slides that I have. Now, it's very important to effectively engage all the stakeholders. And in doing so, we got to think what is best, right, for the world, and give the world what it wants, and not give the world what we want, right? Sometimes as a business entity, we may be a bit over-zealous to roll out our product and services, right? And in my view, the financial services is a major industry, right, in the global economy, with very strong balance sheet and very extensive business outreach. Right? You've got a lot of talent, you've got a lot of customers, clients, and a lot of borrowers that will come to you. and therefore you are in the positions to make a big impact and influence towards the transition from the traditional economy to the cleaner economy. And you will be able to bring together multi-sector, multidisciplinary industry partnership and regulatory corporations to solve most of the issues and challenges that are facing us. Not all, but most of them. And you will also help to advance new sustainability-focused practices, and you will help in strengthening the relationship with all the stakeholders, including the regulators, the supervisors, the taxpayers, and your clients, right? So I hope that we all can work together, and we are part, Deloitte is part of the stakeholders in the ecosystem. I myself too, and let's make an impact together, right?
Thank you very much.
Positive, right, to this world. Thank you very much. Datuk.
Thank you very much, Mr. Yee. Thank you very much. In the interest of time, I think it's quite straightforward. I'm not going to summarize it because I do not want to take the time of the other panelists, because in this particular instance, we actually exceeded the time. When the bell rings, then means your time is over. I'm now going to invite the second speaker, Mr. Pramod Das. As provider of sustainability rating and also working very closely with regulators for the next 5 minutes, you might want to share your assessment on the regulatory framework on sustainability for banks in Malaysia or around the world. You can come from perspective of regulators or from rating agencies, considering that regulators are pushing really hard, on quite a number of these regulatory framework. Over to you, Mr. Pramod Das.
Hi, everyone. Thanks, Datuk. Let me start off by saying that I have no slides whatsoever, and all the training you need on ESG or sustainability you got very early in life. We all learned the basics of ESG in school, but it was not called ESG. We learned that you don't litter, or you need to clean up after yourself. We learned that you have to treat others like you want yourself to be treated, and you need to be honest. Now, fast forward several years, and if you had joined the banking sector, you realize that one of the C's in credit was character. And when you assess any organization, you try and understand whether they are responsible in how they function. And that goes to character in an organization or a borrower. Now, there are a lot of regulations that are coming within the banking system, within the insurance system. There are industry norms that are practiced among institutional investors, whether they're global or local. And all these things point to basically encouraging businesses to be responsible. And from that perspective, and from that same perspective of looking at character and credit, you are trying to understand what the waste or emissions are in the industry. You're trying to figure out whether this waste and emissions will lead to suspension of the business or fines that can disrupt their cash flow, which either will translate to a non-performing loan or an investment that loses its value. And you're also trying to figure out whether this business is causing harm to the environment. From a social perspective, is this business treating its staff well? And if it's treating its staff well, then it keeps and retains its branding, its quality, and its commitment to its products and services. When you look at its supply chain, its customers, is it producing a safe product or a service? Or is it in an industry that fundamentally creates a product that causes harm, such as the tobacco industry or the defense industry? And all of this, again, boils down to its governance. What are its rules and regulations? is it self-governing, or does it wait for regulation to fall upon it? And that will hover around corporate governance. But from the perspective of sustainability governance, there's even the Malaysian Code of Corporate Governance that looks at whether the board and the management are accountable. How are they keeping stakeholders abreast of their journey on ESG? Is the board aware? Are they trained? Do they ask the right questions? Does the board's performance evaluation take this into account, as in ESG or sustainability? And is there a point person in that organization that looks at this? So most of the discussion that you may have come across today is related to risk management, how ESG is part and parcel of risk management. But it has always been there. It was always called qualitative factors. What is actually more important is when we navigate through this period is to look at what are the opportunities there are. And quite a lot of the ESG opportunities don't really come in the form of ESG. They come from the other products and services and solutions that the banks have offered their clients. So if you look at funding digital transformation in SMEs, okay, that improves efficiency, etc. But during this pandemic period, banks that had helped SMEs transform digitally found that their clients did better through this period because maybe their logistics or they had delivery systems that will run off the internet, or even customers could contact them or purchase their goods and services that way. So while it started out as being digital, there was an ESG benefit because there was less carbon footprint in the process. If you look at it from another perspective, the cleanest point probably in our environment for the last 10 years, when you go outside your house and take a deep breath of air, was during this pandemic. It's because we were forced to keep our cars at home and do everything from home, and there was no great need for new highways. There was no traffic jam, the air was clean. So it is basically changing the protocol in how we do work. If the technology was there and how we could do work, people didn't have to go all the way into town to a big office complex. They could get their work done. So eventually it is actually rethinking a lot of things. And for banks, moving away from just looking at ESG risk, the future is looking not at disruption, but assisting clients to transition away from industries that pollute and harm to industries that are green and sustainable, and also create opportunities for the economy. And one key tool that can be used is to use sustainability-linked loans where there are KPIs that will translate into a win-win for the banks and the customers, where if you achieve a particular goal, then there could be a step down in your interest rate or your coupon rates or your financing rates. And there is this wait and see game, you know, oh, let me see what regulations are coming and then I'm going to change. But really the opportunity here is for banks to move ahead of the curve, ask the right questions, look at the opportunities that can transform their clients before regulation changes, look and see which are the clients that will be affected by the changing environment globally, which supply chains will be affected, stepping in, providing advisory to the clients, making them aware. And there are so many tools out there. And where RAM is coming from is we have tools such as RISCO that look at all the ESG risks. And ESG risk is not just about climate change. It needs to look at the social factors. It needs to look at the business governance holistically, and linking again with the strategy, linking again that sustainability is not independent of the business. Sustainability is the S in strategy. And that is the final point I want to leave you with.
Thank you very much, Pramod. So whilst you were just saying that the ESG is not just climate crisis or climate change, we noticed that in the CIA website, Malaysia has been downgraded from 2nd tier to 3rd tier, and Malaysia has been identified as being a transit country and a breeding ground for foreign forced labor. So does your sustainability ratings in RAM include this, the human rights and the labor rights side, social governance side?
When we look at sustainability ratings, we look at 36 different factors. Included in that would be social controversies or factors that affect the supply chain in terms of issues related to the labor, issues related to how the products and services affect the consumers. So the answer is yes, but not specifically to that particular CIA statistics. There are different industries that are affected differently, but anything that causes a controversy or potentially a controversy, we would flag up, and it would be part of our analysis.
Yes, so there are ratings that comes along with it. The second question is based on KPI. So when you provide rating to some of these client of yours, do you look at the KPI on sustainability that is being imputed in the employees, say, of the bank itself? The CEO KPI covers sustainability and all the other management team. Is that included in your rating modality?
Okay, when we look at sustainability governance, we study what KPIs are given to the CEO. We look and see how important the board looks at sustainability. Is there a board member in charge of sustainability? Is there a point person? So typically, it's either the CEO or the Chief Sustainability Officer. We don't stop just there. We look down all the way through how it is implemented at the organization level. And let me give you this story. There was once when I went for to engage with a particular client, and when I arrived at the site, I was taken in a company vehicle to the company office. But before the car started, I was instructed by the driver that if I didn't put on my safety belt, he couldn't start the car and take me to the premises of the client. And so I was very curious. I put on my safety belt, felt even safer than normal. And I got to the meeting and asked my 321 questions, but I saved one question for the end. I said, this is the first time I've gone for a meeting, and I was asked to put on the safety belt when I was seated at the back. And I said, what has changed? I realized that this organization had recently brought in a new CEO, and this CEO came from an industry where the safety standards were very high, and he had given an instruction specifically that all passengers in the car, whether they were seated at the back or on the front, had to have the safety belt on, and all the drivers of all the vehicles were told that if they are the heads of department in that organization were each given a car, but if they did not put their safety belt on, the drivers were to report directly to the CEO to inform him that whether they agreed or not with that safety rule. So from a simple thing, you can understand how an organization practices governance. and the strength of how it is implemented is very important. So it is not important just to have it on a charter on the wall, but how it is implemented at the most granular level. So the short answer is yes, we look at the top down, the tone from the top, but we also look at how it's implemented from ground up.
Thank you. Thank you very much, Pramod. That's a very interesting illustration and analogy. Next, if we go for a meeting after this, probably the same CEO will make sure that we wear something that is recyclable, yeah?
Yes.
To make sure we meet with the sustainability guidelines. I'm going to progress to the third speaker. The third speaker, for short, I call him Ben, but he's got a very interesting long name, Mr. Pradeeban Letsumanasingam. Now, as one who works with pioneers in venture capital and also startup, and as one who actually focuses on technology, he actually advocates in using technology for sustainability solutions, and he's got quite a number of clients doing this, which include banks. So I will probably share with you for the next 5 minutes the real experience in terms of measuring impact of sustainability on the ESG business. Quite a number of it is also from the SME side. So the way Ben and myself have agreed to reach out and share with you all is through question and answer. In fact, the first question I'm going to ask Ben is from your promoting of sustainability towards the startup ventures and companies that you've been working for. Can you just share with us the benefits of sustainability?
Okay, yeah, sure. So I think Datuk, thank you, Datuk. So I think the benefits of sustainability is quite wide variety. So essentially, I think a lot of it, we can look around the space of better access to finance for companies. So I think to resonate with what Pramod said, so potentially looking at improve rates, coupon rates for companies that are more sustainable. Again, then the next thing, I mean, to align is also improve reputation and also risk management when companies actually adhere to ESG and sustainability standards. And of course, the last is its talent and retention and attraction. I think given the shift of how millennials think, especially a lot of them kind of look into, how sustainable and how ESG compliant companies prior to actually joining these companies. So yeah.
So Ben, in your interaction with some of these companies where you explore possibility of venture capital funds, there would be pain points for the SME to go through because some of them just do not know how to progress towards supply chain, towards sustainability, and they need your guidance before they actually go to the bank, because the bank is going to give preferential interest rates if they are in the sustainable platform. So can you share with us some of the pain points for this SME, Ben?
So I think for us, we have identified about 3 pain points. Essentially, I think a lot of the smaller SMEs just don't know how to be sustainable. But I think one reason is sustainability is quite complex and multifaceted, and acting on sustainable data, relevant data is quite challenging. That's one. And the next is, of course, sustainability education is expensive. So when it comes down to SMEs, I mean, is it necessary for them to have anybody who educate their staff on sustainability for now? Again, I think what we said, right? So a lot of banks and also even companies look to only move to sustainability when it comes to like regulations, right? So if you look at Malaysian company, I mean, if you look at large corporates, mostly are doing it because, I mean, they have institutional investors who are ESG aware and are pushing for that. But when it comes to smaller SMEs, they don't, it's a nice to have thing, right? And the last thing, I think 50%, from what we saw, about 50% of companies are ill-faced with a shortage of labor and skills, which relates to sustainability. So as overall, I think with regard to smaller SMEs, when it comes to the question of sustainability and ESG, it's something nice to have, but is it essential to have? I don't think they feel that way.
That's quite interesting. So since you're focusing on SME, and later we will also hear from the experience of Eddie Hu on SME, since you're focusing on SME and the banks are also very interested in supporting the SME to transit into the supply chain of sustainability. So how can banks help this SME? What are the roles of bank in helping this SME from standpoint of collaboration and innovation that has ESG impact on their business?
So I think with regards to banks, I think a lot of banks are currently also collaborating with innovation-driven startups. So for example, a lot of banks work with e-commerce platforms, work with HR management tool solutions to essentially enhance and help their customers digitalize, whereby given COVID, I think that's on acceleration, and I think as Pramod indicated, I think due to this digitalization, there was a reduction in carbon footprint as well. Right, but there are also other startups, for example, that are working on IoT solutions that can help businesses digitalize certain technologies, certain platforms that can help businesses digitalize their ESG or their sustainability reading and indexes. So essentially, I think for banks, it'll be great if they can start working with impact-driven startups that are offering technologies that can improve ESG standards. That's one. Number two is also incentivize SMEs to participate in programs, that utilize solutions that actually address ESG impact. So actually, a lot of the solutions that I will show you after this, everybody only just looks at it as something digitalization. So there will be I'll show you some smart city solutions. I'll show you some platforms as well. But when you actually look at it, no one actually thinks that there's an ESG impact to these solutions. So I think what banks can do is slowly to start to educate their SME customers, it's not only a nice to have, but there's also a longer term benefit of these solutions.
Thank you, Ben. Once you talk about solutions with technology support, how can the startup, which in your experience you have been nurturing, how can these startup technologies help the SME towards sustainability and towards meeting the bank's role? Try to link the bank.
Okay, so okay, yeah, cool. So I'll just kind of generally give an overview of three technologies that usually, that I've seen some SMEs interested in. So some smart city solutions, some smart manufacturing solutions, and also machine learning and AI, artificial intelligence tools, right? So for example, these are two smart city solutions. So one is a smart space sensor and one is a smart water sensor, right? So when it comes to the smart space sensor, in fact, they do a smart space monitoring. So essentially to optimize the utilization of the building space, also the utilization of public transportation. But that in turn, actually given the sensor's ability to detect the utilization of an area or space, it can then work together with all the building infrastructure controlling systems to actually optimize the energy usage. And there's also, the sensors can also, for example, monitor air quality, right? So this also ensures, for example, employee health and well-being. So when we look at the impact area for these sensors, for example, it can look, it covers impact areas such as climate change, health and well-being, and also resource use within buildings or also public transportation. When it comes to the water sensors, I think many people have seen smart water monitoring, smart water meters as well, right? But if you actually look at the impact areas, sensors like this can help with climate change issues. It can help reduce the water wastage, and also it can help optimize resource utilization when it comes to water management services. So then the next solution is smart. We work with a few smart manufacturing solutions. So these companies essentially provide asset tagging sensors, right? So from being able to put sensors in, for example, forklifts, in the employee tags, and also construction worker helmets, they are able to design 3D or 2D or 3D digital twin of the workspace, right? So this technology is essentially asset tracking, but they also provide services such as early accident detection, right? So if you look on the bottom right corner, there's something called a proximity detection system, right? So based on that, for example, in a factory, when a forklift driver is driving a forklift too fast, based on the sensors and the system being able to identify where there are people, if there's someone walking, it will alert the forklift driver that, you know, you need to slow down, right? So solutions like this would reduce, from our POCs that we have worked, it's reduced employee accidents by about 100%, right? So again, the impact area for solutions like this will be employee welfare and also health and safety, which aligns to the S in ESG. And last but not least is machine learning and artificial intelligence. So we have a few sustainability analytics platforms. So generally, when it comes to sustainability review, sustainability audit, it's pretty expensive, and SMEs don't really venture into it given the current situation and given the cost, right? So, but there are platforms, for example, that charge as little as perhaps like about 500 ringgit a month, whereby they provide platforms where SMEs can actually automate and digitalize their sustainability projects, for example. So it's as simple as the SME can upload a potential project that they're looking to work on, right? And using the AI analytics tool they have, this company is able to calculate the carbon emission. I mean, like they're able to do a utility audit, logistic audit, manpower audit. And in turn, they would feed the data into a platform. So then the SME can get a greater and wider access to finance. For example, essentially a startup like this would like to work with banks, right? So then banks will have access to a database or a platform of SMEs with potential projects with their ESG indexes and ESG readings or indexes measured, right? So it can also help the banks with like looking for projects, for example, carbon credit projects, or, you know, financing ESG friendly projects. And also this platform, for example, also offers a marketplace for vendors, solution providers, and also corporates to participate. So again, when you ask what's the impact area, again, it's employee welfare, it's also climate change, and also resource utilization. So for example, if it's a smaller SMEs, they don't really have to, for example, hire someone, an ESG expert into the company to be able to, you know, evaluate their solution. They can use a software as a service platform, for example, like this to, you know, get those readings and numbers. So yeah.
Thank you very much, Ben. It's very interesting, especially when you focus on employee welfare on the S side of the ESG, using a lot of machine learning and artificial intelligence. I will leave some of the other innovation and technology questions later when we have the time, but I now need to progress to the final speaker. We leave the best for last. Eddie Hu, you did you have a slide, and you have a presentation slide, and your presentation slide is focusing on the significance of ESG to we call it SME, but you call it mid-tier definition by Madrid, yeah? And you are sharing with us on how banks can assist SME in adopting ESG in their businesses, which will be a little different from what Ben highlighted from standpoint of private equity. Yours is very much SME, already in business, already profitable, already in operation. So over to you, Eddie, if you can share just in the next 8-9 minutes so that we can wrap up with question and answers after this. Thank you. And if the bell rings, that means we need to stop.
Once again, thank you, Dr. Noripah, for the kind introduction, and a very good afternoon to everyone. So as Datuk mentioned just now, so I will go into practical aspects of how banks generally can assist SMEs into ESG thing. Yeah. So instead of deliberating on sustainability from the banking point of view, so my presentation will be focusing more from the SME perspective. Yeah? So just now, Datuk also mentioned that about the mid-tier customers. Mid-tier customers are customers, companies that are bigger than beyond SME by definition, and I think up to turnover about 500 or 250 million. Yeah? So it's between SME and the listed company. So broadly, can I have my slides up, please, organizers? All right. So basically, I will be touching on 3 primary questions here. So the first question will be about SMEs and ESG adoption. Yeah. So what is so great about ESG, and why SMEs not going all the way out this adoption? Yeah. And the second question, then we will answer why ESG is to SME. How can it benefit in the long run? And the question, I think, which is very relevant to both audience today, because you guys are all so and how banks can help ESG in driving ESG in India. Next slide, please. So I have two charts here. So the next two slides, I have 4 charts here. So these are the chart that I extracted from a survey conducted by Henley Business School on the small and mid-sized companies. So it's all about this. So if you look at the chart on the left, so it shows that 76% of the 91%, sorry, yeah, very knowledgeable, 23%, and moderate knowledge, 69%. So a combination of 92% of the respondents indicate they have good knowledge about ESG. Then come to the chart on the right-hand side about adoption of ESG. So a bit surprising. So only 33%, you look at the bottom bar, started the journey, only 33% of the respondents acknowledge that they have actually started the journey in adopting ESG. More than half, 51% of the respondents says they are still in a very early stage. That means they have probably not yet in ESG implementation. And 16% says they will start in 1 or 2 years. These are companies based in UK. Next slide, please. Okay, this is more on a specific statement in the survey. Yeah. Anything? Can I continue, Datuk?
Yes.
Yes. Yeah. So these are 2 questions posed in the questions. The first one is about the ESG formal purpose statements. How many of these respondents actually understand this formal purpose? And I mean, the responses have been quite encouraging. 75%, 3/3 of the respondents say yes, they are familiar with this kind of ESG formal statement. And on the right chart, it shows that actually 62% of the respondents says they actually fully understand about the integral part of the strategy, and they actually have integrated ESG into their strategy and the company. So, but unfortunately, long story short, yeah, because I'm not going to the details. Or for those of you who are interested to find out the details, you can go into this report, a research report, which is available on the website. So you can go through a very comprehensive explanation. So the long story short, yeah. So what the research says, to highlight the initial message, knowing ESG does not equate to adopting ESG. So many SMEs, many small companies actually need more time to seriously implement ESG principles here. Yeah, that they will based on the interviews conducted with some of the respondents. So the researcher found some inconsistency between the conceptions numerous companies have ESG and the capability they possess to meaningfully and consistently implement in this. There were significant gaps identified in the research. So what this means is that the conclusion reveals that small and mid-sized quoted company in the UK, which are the respondents, even those that have adequate awareness and knowledge of them, but they do not have actually implemented it in their business. So they have this conception about what ESG. So they know, but they thought they know, but they have about ESG. Okay, how about let's go to the next slide. So let's see how SMEs in Malaysia are doing in terms of ESG. Yeah. Can I have the next slide, please? Yeah, I couldn't find any specific research done on ESG, SME on but I managed to extract once a wave from PwC, Family Business, Family Business Survey 2021. So I think this survey is still relevant because most of the family business anyway are SMEs. So look at the chart on the left. Only 12% of these respondents, which are family businesses, SMEs, so have intention to increase their social responsibility and support the local communities. 12%, which are and only 35% of the respondents, family business SMEs in Malaysia, have actually developed and communicated sustainability or the decision makers. So these findings are indeed consistent, right, with the study that I shared earlier, done in UK, while businesses are aware of the significance of ESG. But when it comes to practices, it is still lacking. Right, so same. What I try to point is that all business SMEs in Malaysia are behaving the same way. They know ESG, but implementation is lacking. So this brings us to the next question: why some SMEs are slow in? How can they achieve from the adoption? Next, please. Next slide, please. Okay, I have identified 4 major reasons why SMEs in Malaysia are slow in progress. So the first one, obviously, is lack of in-depth understanding and the misconception of ESG. So many SMEs, when you ask them about ESG, yes, they know. They say, oh, this is good. I mean, for environment, all this thing, And many of the SMEs will tell you ESG is equivalent to what we call CSR, right? Because company they do CSR on an annual basis. You say, oh, they do all this thing. In reality, ESG is more broader. So they don't have the in-depth knowledge and to adopt this as a ESG. And second point is about the low priorities. I mean, talk to this to understand why are they not implementing it? Because they will tell you ESG incurred. When you want to do this, system, you have to buy this system, it incurred. So we attract at the bottom of the list. And of course, they don't have a proper structure, a proper approach in developing sustainability. And lastly is the resources. Is most of the SME they have between tiny capital, so they have limited credit, time and talents. Let's move on quickly. Next slide, please. These are the benefits. So back to the question, why SME should actually embark on ESG or the challenge. So of course, in the long run, ESG adoption helps them to improve financial performance. They help them to manage costs more effectively. Obviously, to value create in the I mean, when you adopt in a proper manner, help to live branding as well. So actually enhance your profit in the long run. What are the key drivers? If SMEs decided to say, hey, okay, I want to adopt ESG now. So what are the things? Of course, one, changes must come from the top. The owner themselves, they need to change their mindset. So they have to accept and integrate ESG. So they have to accept the significance of ESG, the importance, the benefits, why they right. So by doing so, then they will go to the next point to get the ESG policy. Communication again is very important because if the bosses are to drive the initiative, but the staff are don't really understand about it, the whole process will fail, right? So the third point is talking about balancing act by reprioritizing key business functions. So we need to balance out, right? ESG is important, even though it's a short term, we may incur some costs, but it is important. And of course, you have to measure ESG as a long-term benefit. ESG as one of mentioned by just now. I think here you can get the next point, please. Next graph, please. Yeah. Okay. So this is come to the third question, a very quick one, and how Peng as a driving force how SMEs to ESG. So I have highlighted three key here. The first one is ESG agenda. The banks, they themselves need to have a very clear and dynamic agenda, and also to expand the agenda into what do you call it, to have a section where banks can provide raising aid. So this is important because banks can help. All SMEs are bank customers, whether we banks they are. So the second point is about raising awareness. So significance of ESG. I think, as I said, they know. That means you ask them about ESG, they know. So banks with their resources, with their what do you call it, network, I think they can provide very good platforms based on ESG. Knowledge significance. Of course, banks can make full use of it to also collaborate with bank industry stakeholders like and all these life awareness campaign for the SMEs. And last point is to I think this one already mentioned by Ben just now. Banks can actually offer some sort of incentive to
I think we need to wrap up.
Okay, so these are the 3 points that banks can drive. Yeah. So last slide, please. One more slide to go. Yeah. So these are the big key. So I highlighted 3 main points. So number 1 is ESG is for SME. SMEs needs to acknowledge this. So, and second point is we need helps. Point number 3 is banks can to.
Thank you.
Yeah.
Thank
That's
you.
it. Yeah.
Eddie.
Thank you. Thank you.
Thank you very much. Without having to summarize this presentation, it's quite self-explanatory on how ESG can bring up SME to the next level. I am looking at the Q&A. Surprisingly, there is no Q&A that comes along for this. In which case, I'll come up with. In which case, I'll come up with my question. We just have another 6 minutes left before I make my conclusion. So the questions I'm going to ask to the panelists, can you just be succinct in the way you answer it? My first question is to Pramod. Pramod, we are actually fortunate to have RAM as provider of sustainability ratings and also second opinion on green bonds, also Cook. On top of launching a granular risk band called RISCO, R1 ESG 0, which is RAM 1 Earth Shared Goals. Can you share with us responses and adoption by banks on this? How is it different from the Bank Negara climate change and principle-based taxonomy, and also the value-based intermediation financing and investment impact assessment framework that Bank Negara has actually provided? Pramod?
That's an alphabet soup of questions. But and
to answer in just 1 minute.
And so I'll focus on the vitamins in that soup. Whichever matrix or whichever measurement tool that you look at ESG, they all look at fundamentally the same thing. They look at some objective measures for the environment, social, and governance. And RISCO looks at it from a sector approach, an industry approach. And then we dive deep into the particular corporate, how that corporate differentiates itself within that sector. So it is a data platform that allows banks and investors to assess their portfolio ESG risk quickly. but it is only one of the many tools. Eventually, as more data becomes available, we'll continue to refine this tool, and that's when the value comes about. Right now, we are looking at 51 corporates in the portfolio, but we are going to build up this database as time goes on. So hopefully that's concise enough for you.
Thank you. Just a quick answer from Ben. This has been also a critical issue this morning. You know, Elon Musk, in his effort to fix humanity crisis, he wants Bitcoin, but not the carbon footprint of Bitcoin. As you know, Bitcoin uses incredible power consumption and has become a matter of great concern. It uses more energy than the entire combination of Sweden and Malaysia combined. So it does look like technology is the solution, but technology is also the problem. Can you help reconcile for the audience this double-edged sword in your experience as former banker in JP Morgan as well as an innovator?
So I guess as a former banker at JP, when I was at JP around 2008 to 2012, my CEO there, Jamie Dimon, was not for cryptocurrencies. However, at that time, we were looking at blockchain technologies for data flow, for example, like for the credit lending business, to kind of digitalize the whole process. I think, but now JP Morgan has changed their view and they're actually looking to invest in the crypto.
Remember, JP Morgan was mentioned in the video initially, that JP Morgan was
for their green bonds. Yes, exactly, for getting cheap loans from the ECB.
So it's not in the good books of quite a number of bankers, yeah?
No, most top tier investment banks always have issues with regulators anyway. So I think with regards to crypto, I think with cryptocurrency, blockchain is the technology, but crypto is a subset of that anyway. So I think with regards to crypto, there's probably like few inherent issues. So I guess one would be high energy consumption, and one is the traceability purpose for in terms of income, and how do you tax the investors or even the users there, right? So I think there are various cryptos. For example, Ethereum uses less energy consumptions compared to Bitcoin when it comes to mining. But I think, however, I think a lot of the issue around it is because it's not a regulated market. There's a lot of like illegal mining whereby people are stealing energy and power. So I think in my opinion, as a banker, I would say, there's a long way to go, but I think as an innovator, I think probably most government central banks should actually look to see how they can regulate this. Then that would also trickle down into the whole energy usage and consumption perspective. But I think until it is regulated, there'll always be a disparity and issue of its high energy consumption concerns.
Thank you. Thank you very much, Ben. In the interest of time, thank you very much to all the other two participants and panelists, which I didn't have the time to add on some of questions. But we start with a video in this panel session, and now we are going to end with a video. Here is a soul-searching video of mega cities. Mega cities was mentioned this morning, and it was also mentioned in Ben's presentation. And here's a video of mega cities and its impact on sustainability, not just on environmental issues, that E in the ESG, but also the S, which is on social governance. And when you talk about social governance, you talk about human rights, you talk about humanity, you talk about labor rights, and the G on corruption. So the video is very much on the future mega cities that creates quite a challenge on humanitarian being part of sustainability. So what is your role by banks, and what is your role as bankers in this complex world order? Can we share the video with the audience, please?
The future is urban. By 2030, urban areas are expected to grow by 1.4 billion, with that growth occurring almost entirely in the developing world. Cities will account for 60% of the world's population and 70% of the world's GDP. The urban environment will be the locus where drivers of instability will converge. It is the domain that by the year 2030, 60% of urban dwellers will be under the age of 18. The cities that grow the fastest will be the most challenged as resources become constrained and illicit networks fill the gap left by overextended and undercapitalized governments. The risk of natural disasters compounded by geography, climate changes, unregulated growth, and substandard infrastructure intersect to frustrate humanitarian relief. Growth will magnify the increasing separation between rich and poor. Religious and ethnic tensions will be a defining element in the social landscape. Stagnation will coexist with unprecedented development as impoverishment, slums, and shantytowns rapidly expand alongside modern high-rises, technological advances, and ever-increasing levels of prosperity. This is the world of our future. It is one we are not prepared to effectively operate within, and it is unavoidable. Megacities are complex systems where people and structures are compressed together in ways that defy both our understanding of city planning and military doctrine. It is an ecosystem that demands a highly agile and adaptive force to successfully operate within. Infrastructures will vary radically, with concentrations of high-tech transportation, globally connected air and seaports, contemporary water, utilities, and waste disposal intermixed with open landfills, overburdened sewers, polluted water, and makeshift power grids. Living habitats will extend from the high-rise to the ground-level cottage to subterranean labyrinths, each defined by its own social code and rule of law. Social structures will be equally challenged, if not dysfunctional, as historic ways of life clash with modern living, ethnic and racial differences are forced to live together, and criminal networks offer opportunity for the growing mass of unemployed. This becomes the nervous system of non-nation-state, unaligned individuals and organizations that live and work in the shadows of national rule. Where physical domains can be seen, digital domains will have limitless potential to breed and expand without limit. Digital security and trade will be increasingly threatened by sophisticated illicit economies and decentralized syndicates of crime to give adversaries global reach at an unprecedented level. This will add to the complexities of human targeting, as a proportionally smaller number of adversaries intermingle with a larger and increasing number of citizens. The scale and density of these domains is daunting. In a city of 10 million, where you hold the support of 99% of the population, the remaining 1% represents a threat of 100,000. It is an environment of convergence, hidden amongst the enormous scale and complexity of the megacity. These are the future breeding grounds, incubators, and launching pads for adversaries and hybrid threats. Linked globally, these are man-made labyrinths that provide refuge and movement across the vast sections of these cities where alternate forms of governance have taken control. The advice of doctrine, from Sun Tzu to current field manuals, has provided two fundamental options. Avoid the cities, or establish a cordon to either wait out the adversary or drain the swamp of non-combatants and engage the remaining adversaries in high-intensity conflict within. Even our counterinsurgency doctrine, honed in the cities of Iraq and the mountains of Afghanistan, is inadequate to address the sheer scale of population in the future urban reality. From the streets of Aachen to the Citadel and Way, we have defeated adversaries who attempted to use urban terrain to their advantage. Urban conflict is written deep into the Army's histories. But in tomorrow's conflict, these megacities are orders of magnitude greater in complexity, and our current options do not meet strategic ends. Our future operations must allow us to rapidly return the city to the people. They will be too large and complex to isolate or cordon in their entirety. Yet our soldiers will have to operate within these ecosystems with minimal disruption and flow. Our current and past strategies can no longer hold. We are facing environments that the masters of war never foresaw. We are facing a threat that requires us to redefine doctrine and the force in radically new and different ways. The future Army will confront a highly sophisticated urban-centric threat that will require that urban operations become the core requirement for the future land force. The threat is clear. Our direction remains to be defined. The future is urban.
Thank you very much. That would bring us to an end of this whole panel. I would like to thank all the panelists. I have not introduced them when I call them to speak, but in the traditional Malaysian way of saying thank you, I am going to also introduce them as we say thank you to each and every one of them. So thank you to Mr. Yi Wing Peng. He's the Chief Executive Officer of Deloitte Malaysia. Mr. Yi, thank you. And also thank you very much to Mr. Pramod Das. He is Deputy Group CEO of the RAM Holdings Berhad, and also he's the CEO of RAM Sustainability and ESG. Thank you, Pramod.
Thank you.
And thank you to Mr. Pradeeban Letsumanasingam. For short, I call him Peng. He's the director of the Tech Connectors, which are very much involved in innovation, technology, and venture capital. And last but not least, thank you very much to Eddie. He's the managing director of Elegant Hallmark. He was also a former banker, and he provides business-related services on financial technology and general management. And with that, please join me in also saying thank you to KSI and also ECKL and all the audiences that has been staying awake in this graveyard period. Last but not least, Churchill would usually say, as his favorite parting quote, I never worry about action, but only inaction. Thank you very much to everyone.